Hi everybody, welcome back to another episode of JB&D's Market Sniffs. Uh, Recommend you to hop on YouTube so you can watch the video format if you're listening on a podcast. Um, I have a new template here with the Chinese theme. Um, Red because next year is the year of the horse, the fire horse. Um, and I know Chinese New Year is still a couple weeks away, but just getting ahead of it. Don't want to put a green theme for the year of the snake if I'm just gonna have to change it soon after. However, if you see where I have my social links right under my webcam, I don't like that. I think I'm gonna change it. It looks cheap to me. It looks low quality, or I feel like it just yeah, I don't like it. Oh, another thing I don't like. I don't like how you see the reflection, you see the glare on my glasses. I hate it. I need to figure something out. Um, because I could keep them off, but I don't want to because then my eyes feel strained and yeah. Okay, let's get into it. Let's get into it. Let's talk about the elephant in the room, FOMC. So as you may or might not know, that the Fed cut rates by 25 basis points. Um, I want to point something out, okay? Jerome Powell says the US may be drastically overstating job creations by up to 60,000 jobs monthly. 60,000 monthly. 60,000 jobs monthly. Okay. Um, he's suggesting that he is suggest. I don't know what's up with my speaking today. He is suggesting that the labor market may be weaker than we actually think than what the numbers are currently showing us. Uh, I feel like this is something that the market has been overlooking. Has overlooked today. Um, yeah, because unless they didn't ignore it and the market took it as a bullish sign for more cuts. But again, if you're getting the cuts for a weaker economy, is that really bullish? Do you know what I mean? Um, I just feel like that's something that the market may have overlooked or didn't put as much weight into it as it should. Um, there was something else about the FOMC that I wanted to point out. Let me see if I can remember. The dissents. There were three dissents. Okay, Stephen Moran. Um, but he wants more cuts. He wanted half a cut. The other two wanted no cuts. That was Austin Goolsbee and Jeffrey Schmidt. Um, they wanted rates to stay unchanged. Okay, I think that was another thing that was overlooked by the market today. Because the market did pump. Um, Previously we had two dissents. Now we have three dissents. Two of them wanting to have kept rates as they were, and one of them, let's just ignore that guy because he's just a little puppet for Trump. Um, yeah, I think they're overlooking this. Anyways, I'm not even gonna go into the whole next Fed president and the cuts and but you know what? How many how many um how many what's going on here? How many cuts it is market pricing in for 2026? Because if I heard right, it's pricing in like two, one next year and another in 2 years, something like that. Um, but okay, Fed sees only one rate cut in 2026. Yeah, I think it was the one in 2026 and another one in 2027. However, Are we being for reals right now? Like, be fucking for reals. One, come on, we're gonna have the next Fed president come in, and Trump is gonna interview them, and he's gonna select whoever seems that they'll be doing what he wants, and that's at least two cuts at the towards the start of their term. Maybe two. I don't think they would do two off the bat. Maybe one and one. But yeah, again, I don't know what's up with my speaking today. I feel like, yeah, I don't know. It's weird, very weird. But yeah, I think we're gonna get more cuts than what the market is currently pricing in or the Fed is pricing in. That's another thing that's I think is being overlooked. But some might see, oh, then that's bullish, right? But again, I don't think all these cuts are bullish. I see them as bearish because I see them as inflationary. When two-thirds of inflation is being demand driven, that's gonna lead to more inflation if we bring rates down. Plus all the headwinds that I mentioned 2 episodes ago now. See, I had literally said that I was not gonna go into it, and here I am about to go into it. Anyways, let's see this article. I haven't read this article yet. Powell's hawkish talk could just be talk. Why the Fed might not be done cutting rates. Contrasting with market expectations of two cuts. Even then, I think we get more than two cuts in 2026. And I'm not saying this is because we need two cuts, more than two cuts. I mean, um, just for different political reasons, as you know already. Let's see the decision result. Upgraded growth forecasts, lowered inflation projections. I don't know. I don't. This is not making sense to me. Powell's thinking that labor market may be way weaker than what the current data is telling us, but they rise growth forecasts, which probably means they're expecting AI to boost productivity, which I think is yet to be seen enough to actually um, give that growth, that boost to growth. Um, yeah, give me 1 second. Okay, let's see. Adobe earnings show rapid adoption of AI tools. Did their stock go up? I don't know. I don't really rate this right now. All right, next topic. Next topic. Oracle earnings beat, but they're rising capex forecast. Um, and what else was it? The market didn't like their guidance or something like that. Free cash losses. Yeah, their quarter guidance, which is a little light. Yeah, man, look at this. They had went from cash flow positive all these years, and now what? Cash flow negative last quarter. Again, this quarter they're cash flow negative. They don't expect to be cash flow positive again until 2028. Uh, so yeah, things aren't looking good for them. It's a good sign though. For me, in my opinion, this is a good sign because it shows that the market is finally, investors are finally starting to maybe see some concern or show concern over all this capex spending and how it's affecting the free cash flow of these companies. So I'd much rather see Oracle dump on this than pump even more. Um, yeah, they expect 2026 capex will be about 15 billion higher than they forecasted in quarter one. It'd be like that. Yeah, crazy man, crazy stuff. Um, those were the two big things I really wanted to focus on in this episode. Just a quick overview on my opinion on the FOMC reaction today and Oracle's earnings. Obviously didn't really go too deep into Oracle's earnings, but just a quick overview. This market lab is 4 days old. Okay. Uh, for this, I like to look at the Delta market sentiment. Under 50 bearish, under over 50 bullish. At 52, it was uh, it's hanging in there. Let's see. Purchases. Blue Owl, really? Pfizer, Grinder. Always just GXO. Oh my God, that's amazing. I'm always looking at this section right here just to see if maybe, just maybe, one of my long terms is in there with purchases. Hopefully not the sales, but purchases have more value, hold more value than the sales. And look, GXO number one insider bought 6,000 shares for a value of 300,000, 303,000. That's good. Nice. GXO Logistics. Yeah, 41 million sold for Life 360. I didn't even know that was a stock. Okay, now this is all the 2025 purchases. Ah, okay. Sales. Mhm. Oh, another thing I wanted to go over. Okay, going back to Jerome Powell's comments about the labor market might be overstating or whatever be may be overstated by 2,000 jobs per month. JPM had news yesterday. I think they revised guidance and they lowered it. Um, and something like that. Something about the consumer being weak or like not using the credit card as much or something like that. Which is interesting to me. God damn it, paywalls. Look right here. Characterize the current economic environment as being a little more fragile. hmm Stated bank sees full year 2026 expenses at 105 billion. The estimate for total non-interest expenses 101 billion. Remain relatively flat year on year, quarter on quarter for bank deposits. Restaurants and retailers seeing people tone things down, lower income, tread water, demand for labor is weakening. Okay, that's not the only company that had been warning about economic concerns. PayPal was doing that the past 2 or 3 weeks. The CEO came out once or twice talking about or it was a CEO, and maybe the other time was somebody else on the board. Um, just mentioning how the consumer, um, just economic worries, okay? Economic worries. Um, but yeah, it's just interesting to me how these financial companies are talking about these things now, and the market's kind of just ignoring it. Because their stocks do get affected, but the market still doesn't care. The market is still, they're still on their high horse. The market's still on its high horse. Uh, what else? Okay, market sentiment. Euphoria still. Yep, I agree with this. That's different than CNN's though. I have to read over the market year and zero hedge articles, but I have to leave soon. So I'm just gonna go over these things that I have in the Discord. Um, and then that'll be it. Okay. The new things that I added from Bank of America Research and Apollo. Okay, Apollo, let's start with Apollo. Long-term interest rates are higher today than when the Fed began to cut interest rates in September 2024. Okay, so I'm gonna keep an eye on. Ah, mm, okay, here, but then lower. 2 3 months later, it's been a whole year now. It's still long rates have disconnected from shorter rates. So I'm gonna keep an eye on. 10-year treasury higher than when oil prices would have predicted. Yes, I'm gonna keep an eye on, okay? Um, consumer went, okay, this is from the Consumer Report Checkpoint, whatever, from Volvo Institute. Consumer momentum closed in November. Total car spending was flat month over month in November, falling 8.3% month over month increase in October. My speech is all over the place today, and now I have a lisp. The hell is going on? Uh, okay, you see that? Lower income households spending growth was 0.6% year over year in November compared to 2.6% year over year for higher income peers. Again, nothing we don't already know. This is K-shaped economy. You see this? You see higher higher income are spending more. They have more to spend, obviously. Their things are better for them, obviously. In November, higher income households wage growth tickled up slightly to 4% year over year, while for lower income households it was only 1.4%. K-shaped economy, man. Thanks. The majority of holiday spending occurred online both this year and in 2024. I like this for my Etsy. Etsy. I could also add it to Vans Corp because it's retail. Um, what else? Estee Lauder. I mean, it has more significance for Etsy because Etsy is really only online. But the others sell online, and I'll just add it to those rooms, so that I can go back to that and see the importance of selling things online. And for Estee Lauder to uh, dominate these online platforms like TikTok Shop and all that. Consumer spending on holiday items was a mixed bag, with consumer spending and purchasing more year over year overall online and in the clothing category. Meanwhile, general merchandise saw stronger spending, but a slight pullback in purchases year over year. And so online, again, more, clothing more. Okay. Um, in our view, MB that consumers are becoming more price sensitive and selective this season, especially given stubbornly elevated inflation and potential price increases due to tariffs. This is likely as shoppers often have total spending goal in mind for gift giving. So in the face of higher prices, they are economizing. It could also be that some retailers are absorbing some cost increases while others have passed them along to consumers. Okay, so for online, for example, more transactions, less spending amount. Maybe they're really being selective on things that they're buying. Um, and I guess it could be a surprise. We would have thought that we see fewer transactions and more spending amount because of higher prices due to tariffs, but that hasn't really been the case. That's why they're suspecting that maybe some retailers are absorbing some costs. And yeah, but being price sensitive, it's we've known that for a couple months now. They're gonna be deal seeking, discount seeking more, and that's why I'm playing Ibotta for the grocery play. A higher share of consumers is using buy now pay later across all income cohorts, but especially lower and middle income households. But oh my god, this is what I like about PayPal though. PayPal has a buy now pay later, but they did that deal a month or two ago with whatever company I forgot, where that company would be liable for um like if consumers were not to pay back their buy now pay laters, that company would be responsible for that and deal with that in exchange for something else. I forgot what it was, but that's what I like. So, but not for all of it, for a portion of it. Either way, that removes PayPal for a portion of buy now pay later risks. It takes them off the hook for a portion of that. Spending on buy now pay later platforms remained low in November, especially as a share of total retail spending. Hmm. So it was higher. What's that? January? I expect was so much that time. Maybe it's supposed to be December. I guess we'll see the spike next month. Yeah. But yeah, that's all I got. I'm sure I could find more, but I have to go. Yeah, tomorrow I'll read some market ear and zero hedge articles and see if I record a video or something. I won't be recording videos every single day because sometimes it's just there might not be anything to talk about. Um, and this is the beginning of this podcast, so I still need to figure out if I really want to do this every day or 2 or 3 days a week, or just once a week, or if it's just gonna be random for until whenever. Um, I really don't know. One thing I want to note: futures are dumping. They gave back all the gains from FOMC. Not looking good. Might have to do with Oracle's dump overnight as well, and maybe it's just starting to digest those details I mentioned from FOMC earlier. But yeah, thank you for watching. Am I forgetting anything? Nah, and if I am, I'll talk about it next episode, right? All right. Thank you for watching. Make sure you like, subscribe. Um, give us 5-star reviews if you're on the podcast. And if you're on Substack, subscribe. It's free. I'm not charging for anything. Everything is free, okay? And before you leave, nothing that I mention in this podcast, video, or anywhere is financial advice. None of that is financial advice, okay? Nothing that I share is financial advice. Everything I share is opinion only. Talk to your financial advisor before you make any financial decisions. I am not liable for any financial decisions that you make, okay? But yeah, thank you for watching.